What are the five basic categories of income? Passive, portfolio, ordinary. No, a category of income is not the same thing as character.
I don't know what the hell I was talking about on that star. Hopefully that becomes more apparent as we're going. I don't remember the point I was making there, which doesn't surprise me. Okay? So, passive, portfolio, ordinary. Why did I say that?
Did you flip to individual?
Do what?
Did you flip to individual from business?
Probably, but the answer to that is yes. But I'm making a point, and hopefully it dawns on me what point I was making. Okay. Allie, what's number 2 saying?
What in general is passive income? No, please pay particular attention to this discussion because this concept is likely to repeat in Let's Learn Some Tax 1. General boundaries. 1, a taxpayer can generate passive income. 2, a taxpayer can generate passive loss. 3, a taxpayer can offset passive income with passive loss. 4, if the passive loss is more than the income, the ability to deduct the loss is limited to passive income. Any excess is carried forward.
Okay. So this is, we are going to hammer on this pretty hard today. Okay. So there's a concept, and I'm going to briefly introduce it even though we're going to hammer on it pretty hard as we go. There's a concept that says if I have a short-term gain of $100 and I have a loss of $100. Allie, how much taxable income do I have? And it's my third favorite answer.
Depends.
Depends. It depends. Okay, and why do I say it depends? It comes to zero, doesn't it? Okay, so you have to, Sam,
Diagnose.
whether we can take that loss. Okay, you have to be able to diagnose whether we can take that loss. Okay, and we're going to introduce the concept today, and there's a tab or a book in here somewhere. It might be in here somewhere. I don't remember where it's at. It's probably in day 3, called Loss Hurdles. Okay, so Sam, Loss Hurdles helps us diagnose whether we get the ability to take this loss. Okay, so let's relate this back to what Allie just said. Okay, it says taxpayer can generate passive income, taxpayer can generate passive loss, taxpayer can offset passive income with passive loss. If passive loss is more than income, then the ability to deduct it is limited and the excess is carried forward. Is that not what that says, Allie? Okay, so in part of the diagnosis, it's called loss hurdles. And the first hurdle for losses is, do I have basis? The second is, do I have at-risk basis? The third hurdle is passive. Okay, so you have to diagnose, right, Sam? At the third hurdle as to whether we can release that loss or not. Okay, then the fourth hurdle is excess business loss. So if this loss is passive, we might stumble at a hurdle as we go and get blocked from being able to take that loss and then carried forward and have 100 short-term gain, 0 loss because it got blocked by a hurdle, and I have $100 of income. We're going to talk a lot about those hurdles, but passive is one of them, is one of the hurdles. So passive income greater than passive loss, passive income taxed, passive income less than passive loss, nothing taxed, but you have a passive carry forward. Passive income equals passive loss, nothing's taxed. Okay? And that is important for the hurdles that we have that we're going to go through. Allie, who you want to call on?
Chris.
Number 2, passive discussion continued. 2A, if passive loss exceeds passive income, what happens to the passive loss carry forward? Passive loss is carried forward until used or the taxpayer passes away. passive loss will offset future passive income.
Okay. What's 2B say?
2B, as a new person, how do you diagnose whether or not income is categorized as passive? We are here to build a foundation, not to make let's learn some text. One, participant and expert. How do we build a foundation? We provide rules of thumb that allow a member to recognize the issue. What are the rules of thumb? One, for non-real estate, does the taxpayer spend 500 hours or more in the activity? If they do, it is non-passive. If they spend less than 500 hours, it's passive. Number 2, renting real estate is
Well,
always.
let's stop there for a second. We're good there for now. Okay, so again, are we here to make you an expert? The answer to that's no. There are, I'm going to say, 8 potential different, Sam,
Diagnosis.
diagnosis to determine whether somebody is got a passive activity or whether it's an active, whether it's active. Okay, but the one that you're going to use most commonly, and I think that you can remember and has the most application in your world, because Chris, we are not,
Experts.
but we need to be functional. Okay, in the pursuit of being functional, the rule that you need to remember and learn is 500 hours. So if somebody spends 500 hours on a trade or business, then they're active. Okay, and I don't know if I talk about this in here or not. If I do, I apologize for getting ahead, but this is worth knowing. And you should know this as a staff person. Okay, you have business A. Now let's do this. That's better. You have A owned by Matt, and you have B that's owned by Matt. And Matt spends, I'm going to say, 500 hours here and 400 hours here. Okay? So the question I would have, Chris, is Matt passive in A? No. Is he passive in B?
Yep.
Are you sure?
Well, it depends if it's real estate.
Nope. But it is depends. Okay? And this is a little bit more expert. It's just this is, again, building a foundation to know something. Okay? Depends. I'm going to say, for purposes of what we got, in one instance, that both of these are bowling alleys. Okay? And Matt runs both of them. Okay? Now let's say the second instance, one is a mortuary, and the other's a flower shop. Okay? And the question becomes, can you say by characteristic, are they similar enough that you can group them together and count it as 900 hours on one activity, or are they dissimilar enough that they can't be grouped together at all? So Sam, you have to diagnose whether you can group them together. And if you have the opportunity to group them together, then you can do a grouping election and pull it in. Okay? So the one where we said we had 500 hours, then yes. 400 hours, maybe, if we're able to group them. Okay? But the rule that you want to really keep, Chris, is what?
It depends.
Nope, 500 hours. Okay, yeah.
Would a hobby net income fall under this too? Like, if it's even though it's not necessarily a business, like if they're spending 500 hours or more.
Well, so hobby income. Okay, you're asking if that's passive or that's such a hard question to answer, because at the end of the day, hobby by its nature is not really a trade or business. Okay, so now you're in the hobby loss rules that says, well, this is a hobby and my income's going to be capped or my losses or expenses are going to be capped because it's a hobby. But then there's another rule that says that under the diagnosing whether this is active or passive is if you're the person providing the only amount of effort in the middle of this thing, then you're not passive with respect to it, which kind of feels like that'd be a hobby. But since you're limited on the expenses, then it doesn't matter. Okay? Or at least that's my view of it. You have a different view, Brett?
I think that's fair. Is it just the hobby thing? You have to show income every 3 years.
You have to show income every 3 years,
And
yes.
then you can get around
Right.
the hobby rules.
Now, Brett, the tax planner, showed up to say, hey, as long as you're showing income, and I think it is every 3 years.
Yeah.
Is that a hard rule or is that a rule of thumb?
I think it's a hard rule.
I don't know the answer to that.
Or if it's not every 3 years, and it's 2 out of 7. I don't know.
This is
The
probably
3-year one, I feel more confident in.
okay. So this is where I would Google something and go, is he right or wrong? Because I'm in the I don't know category. I can't remember those rules honestly, what they are. I know they exist, and when I was closer to your age, I did in fact know those rules. I love being able to have that disclaimer that at one point in my life I probably knew those rules, but I don't today, and I don't today. I don't encounter them anymore. Yeah.
Is it more advantageous, like if you're talking to a client, like consulting them, are you like, is it more advantageous for them to be passive or non-passive generally? Or is there not a way to, is that way too broad to even answer? Like when you have that situation, are you like,
What's my third answer?
it depends?
It depends, because okay, you deserve this, by the way. Okay, because there's a rule, maybe I covered this, there's something called self-rental, okay, where you have an S Corp that's owned by Matt. Oh, I should have kept this fucking up here. B, 400 hours, 500 hours. This generates, $1,000 worth of loss. Matt's passive with respect to that. We're going to talk about the hurdles, but since it's passive, and then you have to do the third hurdle is passive netting. There's no other passive income. It gets stuck. Okay? So is it better to have passive income at this point or not have passive income at this point? Because if you have passive income, you can now harvest that loss, because you can take passive income and passive loss and offset them. That's what happens at that third hurdle. So it'd be better to have passive income. So Brett, the smart tax guy, says, rental's always passive. All right, fine. I'm going to have my corporation, which is owned by Matt, run a building and generate $1,000 of income. So rent, by definition, is always passive until it's not. Does it appear, Sam, that I've now structured into being able to take my $1,000 of rental income and offset it against my passive loss over here? It would appear that that would be true. But the IRS is a little smarter than they look. They say anytime you structure into a self-rental situation, they say the income generated from that rental is not passive, but the loss is. It's maddening. Okay, so the answer is it depends, because you have to look at your client and diagnose what their fact pattern is to know, well, they have all this passive carryover. Is there a way for me to generate that? Can I do something? Or, boy, they're trending towards passive. Is there anything I can do to prevent that, to stop the loss? There's no answer that's correct without knowing what the taxpayer's fact pattern is to diagnose what the correct action would be. Okay, let's see. So we talked about 500.
Pete, on that top point there,
Yeah.
above 2B. No, on here.
up
Above 2B, when you say how do passive losses get freed up, should there be another one in there that you dispose of the activity?
Yep, 100%. So why don't you tell them what that means, because I'm not smart enough to do it. I wasn't able to put it down there.
Do you have a passive activity that's been building up losses over time, and then you dispose of the activity 1 year, you get to release all those passive losses in the year disposal?
So Said differently, if Matt sold his B stock or B sold substantially all of its assets, then that $1,000 would get freed up as a deduction today because you've disposed of that activity. That's a very good distinction. Okay, Chris, what's this last point say?
Renting real estate is always passive until it's not. Self-rental does not produce passive income, and real estate professionals' income or loss is not passive.
Okay, and are we experts or are we just functional?
Functional.
Functional. It goes beyond those two. Okay, there's something called short-term rentals that, that barely touches what we do, that says if I'm renting cars or if I'm renting a hotel room that's 7 days or less, there's other things that make renting not passive. But in terms of the things that we're going to be affected by, self-rental, which is this situation here that Sam asked the question about, didn't even know he was asking, okay? And rental professional is the other thing. So I don't know if okay. Sam, what's this say?
Passive discussion continued. 2C. In general, what is self-rental? From a foundation standpoint, not expert, is when a related taxpayer rents property from a related taxpayer.
Okay, so what's the one say?
Down below.
Yep. Right
Assume Pete
here.
owns.
Nope, right here.
Oh, sorry. Exco and P1 are related. Exco is renting a building from a related entity. Income is non-passive. The loss would be passive.
Okay. The loss is passive. Passive income is not passive. Why would this be? And that's going back to this example that we've put up over here where Matt owns two entities and he's trying to spring his passive loss. He's creating a fact pattern utilizing rental rules to say, well, rent's always passive. Therefore, I can offset the passive income because I only spent 400 hours on operation B or entity B. Assume Pete owns YCO, which generates $200,000 loss, spends 100 hours. Pete has another services income, 200,000. Is YCO passive? I'm gonna probably say yeah. It's only 100 hours. Same facts. Exco and P. Pete does not like the passive loss from Y. Pete knows rental is always passive. Pete enters into a contract with P1 where he generates 200 rental income. Did he solve his problem? Max?
Sorry, I was definitely not paying attention to that second question. I was reading the first part still.
Okay. All right, well, let's just do it together. I did a little fast. What's one say and then what's two say? Max? So if I did it fast for you, I did it fast for everybody.
No, I was just kind of behind. Basically, in the first one, it's a passive activity because he's under 500 hours of performance in the business, which, since that company generates a loss, they won't be able to take it. It's the passive activity loss. Same facts. Pete has just not like passive loss, but he's suspended. Pete knows what is passive. Generates 200. No, his. It is not. What do you call it?
It's not passive because it's self-rental.
Correct. Any income from that is non-passive.
It's
and
ordinary,
any loss
yeah.
is passive.
Let's see. Luke, what's 2 say here? 2D or whatever.
Let's see. What is a real estate professional? Remember, rental income and rental loss is always passive unless self-rental or real estate professional. In order to be a real estate professional, you might have to meet certain criteria. You have to spend 750 hours or more per year on real estate activities. No, real estate activities include more activities than you expect. Delving into this is more than expert than foundational. Please just know that there's more to know. Real estate activities make up more than half of the taxpayer's time. Then we have a breakout of 2 individuals. So we have Pete with 700 hours, and he takes half his time, and he has a $200,000 loss and a $200,000 W-2. And then Jeff has 770 hours with the same time loss of W-2.
Okay, so since Pete's not a real estate professional, it's passive. And going back to those loss hurdles that we're going to talk about maybe today, maybe tomorrow, that loss is going to trip at one of the hurdles, the passive hurdle, and it's going to get limited and carried forward because Pete's not a real estate professional. Jeff, on the other hand, that spends more than 750 hours and more than half his time, he's a real estate professional. So what's the punchline? Since we're not making you an expert, but we're making you functional, we're saying that rental is always passive with the exception of 2 instances. And what are those 2 instances, Connor?
The 500 hours and then the real estate professional.
Self-rental.
Self-rental.
So rental real estate is always passive unless it's self-rental and real estate professional. Okay, those are the 2 that we're focusing on. Okay, so self-rental, we kind of got our head around maybe a little. It's way harder than what we describe it. But with respect to real estate professional, if I was going to ask you to pick up 2 pieces of data and carry it forward with you to Sam,
Diagnose.
whether somebody's a real estate professional or not, it is, did they spend 750 hours or more in the activity, and was it more than half their time? Those are the 2 things that you need to use to Sam, diagnose whether somebody's a real estate professional or not. And going back to this A-B, and this was 500 hours and this was 400 hours, and we have to make an assessment of whether we can group those and say that, well, is it a mortuary and a flower shop, and you have same management team, and there's all these different criteria to help assess whether this can be grouped. For real estate professionals, if A and B were 2 separate real estate entities, well, is 500 more than 750 or is it less? Less. Is 400, Jackson, more or less?
Less than 750.
If you add them together, is it more or less? It's more. Okay? So the IRS says that we're going to make you measure that 750-hour standard against each activity. A and B are treated as an individual activity. So there's a grouping election. The first grouping election is 469-6, 1.469-6. The second grouping election is 1.469-9, and 1.469-9 says, hey, if you're a real estate person and you just say they're grouped, they're grouped. Okay? And the other thing, which is worth knowing but is probably trending more towards expert, is when you're grouping businesses. So there's 2 grouping elections. And the way I categorize those grouping elections is I got A and B. That's an entity/business type election for grouping. That's -6, 1.469-6. And you have to do an analysis of whether we have common area, common management, ownership structure. There's things that you use to, as Sam would say, diagnose whether we can group them or not. There's a more stringent assessment of whether you can group them. Then, if we tack on Operation C into this, under the business side of the election, then you have to affirmatively elect to group C in if C meets the criteria. You have to say C's in. But if A, B, and C are real estate and you do a grouping election, and I'm generally more conservative than some of my my members that are in the firm, it says in the regs to me that once grouped, always grouped. And anything you introduce into the real estate grouping election is automatically going to attach on. So once I say, hey, I grouped A and B under the real estate side of the grouping election, C automatically tacks on. So if I spend 1 hour on C, then guess what? I have 901 hours under the real estate because it's all grouped together. Under the business, I have to, on the year it was introduced, group it in with A and B and affirmatively tell the IRS they meet the criteria, I'm grouping them in, and I have 901 hours because I've met the criteria.
Pete, you got to file that election every year, even if no changes are made.
I don't think so, but do you know a rule I don't?
I was just thinking we attached a statement every year confirming the election.
I would go with whatever he says on that because there was a change in maybe 2017, I can't remember whatever year it was, that changed some of those rules. And Brett could be 100% right about that. I don't know. And if we do that as a firm, somebody smarter than me probably looked at it and made that choice to group. But you're not talking about real estate, you're talking about businesses?
Businesses.
Okay. I defer to Brett because there's only two answers, right, Max? The answer and I don't know, and he's got me at a disadvantage. I genuinely don't know.
Have you ever seen an election get challenged?
I've seen an election get challenged insofar that they say, was it made? Really, was it really made? From that perspective, because we pick up clients, but I've never seen one where we've affirmatively made an election and they went through an assessment of whether we had common management, common geographic location, common business activity. I've never seen that challenged. But that doesn't mean it hasn't.
Got a question for you.
Yeah.
How much do you stress to like your clients that, hey, you need to track your hours? Like, is it sort of one of those things like you're talking about the board minute meetings where, hey, you kind of shoved in there? Or is it like pretty important? I don't know how aggressive the IRS is on that.
What's your instinct say, Matt?
Things are flexible. That's what my instincts say, but.
Well, here's what I do is you have to prove that you spent the time. Okay, the board minute meetings is literally grabbing a piece of paper and going, I hereby said a bonus was due, run it through the printer, and it spits out, and you don't know what date this happened. Okay?
Yep.
But this 500-hour thing is a little bit more challenging because if somebody, for example, is out, and actually the example that pops in my head is real estate, so I'm going to go with that. If somebody is out before the real estate tax authority and say I'm replatting and I'm dealing with contractors and I got all this stuff that I'm doing, grabbing those pieces of data as you go as a defense is way easier than trying to, well, I printed my board minutes and it's all good.
Yeah.
So the encouragement is, hey, you really should be tracking this, and not because if it ever gets challenged, it's way easier to gather it up and have it as truly contemporaneous versus going back and putting Humpty Dumpty back together and gathering that data. So I generally encourage people to do it because it's just harder. Let's see. Matt, what's this say?
We just read this part.
Yeah, 2E. I don't even know what the hell I'm talking about.
On the next one.
Next page, sorry, here we go. What does the 500-hour rule mean in making the determination of whether a business activity is passive or active? Multiple tests can be applied in making a determination of whether an ownership interest is classified as passive or active. However, the 500-hour test is the foundational rule or rule of thumb I think you should remember.
Okay, so my only point that I was making here, and I've already made it, is from a business diagnosing whether a business is active or passive, the 500-hour rule is the rule I want you to remember. That's what I'm trying to say there. And from a real estate perspective, Chris, what two things do I want you to remember?
It takes up half your time. It's over 750 hours.
Yep, and I'm probably going to say that next. Is what? I don't care. I'm going to skip that. Okay. And that's basically what this is saying. So, Chris, what's this saying? Just so we're all on the same page.
I know it's talking about grouping.
Is that what I'm talking about here?
It says it at the bottom of B, but it's talking about the 750-hour rule and more than half the taxpayer time. However, if the taxpayer owns 10 businesses or 10 real estate ventures, how do these rules apply?
Okay, this probably is about grouping, which we've talked about that. And so, is everybody in here? Everybody was an intern in here, I presume? Okay. How many real estate entities do we do? Partnerships? A lot. Okay. And how many partnerships, how many people have different partnerships with different pieces of real estate that are on the 1040? A lot. Do you suppose knowing that 750 hours and more than half your time might be a good rule to retain because we do this a lot? The answer to that's yes. Okay, what is portfolio income? This is basically your brokerage account. Interest, dividends, capital gains. Can portfolio income be both portfolio income and be deemed passive? Jackson, what's this say?
It says in general, no, but gain from disposition of a passive activity can be classified as passive.
Wow. Okay, so let's do this. Because, and I don't know if I put this in here, so if we did, let me apologize in advance for going ahead as usual. Okay, I'm gonna have, this is a partnership for just a placeholder. It has AR of 100. It has a brokerage account. It has basis of 500. It has, I'll leave it at that. We have, let's say we have activity 1. That's 400. Activity 2, which is 200. And that comes out to what? 1,200. I have AP of 7,200. Equity negative 5,000. And I have A that has a $5,000 passive loss carryover. Okay? Yeah.
Wouldn't
Is my math
70
wrong?
Yeah. Wouldn't 7,200 minus 5,000 be 22,000?
6,000. Thank you. Did you catch me?
Yes, sir.
You know, you're this year's Jameson. Because Jameson always harvested all the gift stickers because she was paying more attention than some others and caught me on stuff. Okay? So, what this is saying, well, let's do this. In scenario 1, we sell the full brokerage account. Okay? And for, let's see, for $6,500. Base is 500, gain of 6,000. My K1 says $6,000. Am I active or am I passive with respect to this entity? I've already told you I'm passive, right? Because I get a $6,000 carryover.
It's for A though, not 1 or 2.
Do what? No, that's activity one or 2.
Oh.
So let's make this an S corp because I that's better from the standpoint I can have a sole owner. right? So A is the sole owner of A, or of X. A is the owner, is the sole owner. I have a K1 that comes out to A with $6,000 worth of income. Now, $6,000 worth of income, we said that passive income can offset passive losses, did we not? Do I get to use that $6,000 to offset the passive loss? Carter's shaking his head yes. At least Max is saying yes. Matt's saying yes. The answer is no. Okay? What the rule is, it says, well, wait a minute. Activity 1 and activity 2, these are passive. The fact that you have a brokerage account just means you kept money inside the entity. So there's a rule under the passive rules, which is code section 469, that says interest, dividends, royalties, annuities are automatically deemed to be not passive when it comes out unless they tell you it's passive. So the $6,000 that came off the sale of the brokerage account is not passive. It's portfolio. But if we sell activity 1 for $6,400 and have a $6,000 gain, is that now passive? It's capital gain. Is that passive? It is. Capital, not passive because it's portfolio, because interest, dividends, and annuities are deemed to be not passive. But the sale or exchange of the passive activity, the gain from the passive activity is passive. And that gain, I think, goes in box 11 on the K1, and it says gain. So there's the K1s, and I think we have a separately stated discussion. There's a line on the K1 that says capital gains. Well, capital gains would have the $6,000 on it because it's capital gains. But line 11, can't remember, I think it's 11. So you're not even,
Are you talking the other income boxes? Yeah, it's 11.
oh boy, that was pulling one out. So 11 says capital gain from passive activity. So as a preparer, if they did it right, you would know that that capital gain is passive in nature and can offset other passive income.
Is it non-portfolio? Is that what it says? Other income, non-portfolio capital gain?
Maybe depends on the code.
I don't know. Now I'm over my skis. I got to defer to Brent. Or Trent.
I think it depends on the code in the boxes.
So you said in general, no, like, is there an exception to that then?
What?
On 3A.1, you said in general, no portfolio cannot be deemed passive. Why isn't it just a hard no?
Because of this. Okay, because the 469E, maybe, says that interest, dividends, annuities are all deemed to be not passive.
Got it.
But then you have to, Sam, diagnose, and box 11 should help you diagnose that the gain that's being generated is passive.
The way I think about it, Matt, is your passive losses that he's talking about, the carry forwards, are all determined on Schedule E of your tax return. The interest and dividends and cap gains that are reported through a brokerage statement, it shows up on your K1, but those don't go to Schedule E. Those flow through to Schedule B or Schedule D, so they don't get calculated in your passive losses.
Okay.
Luke, what's this say?
Let's see. Can portfolio income be passive? Example where gain is not passive. Pete owns Xco and he is a passive investor. Xco had a loss from operations of $500,000 and sold one share of Berkshire, a stock that generated $500,000 gain. So then we have an ordinary loss of $500,000, capital gain of $500,000.
Every time I'm saying taxable is 0, but that should be 500.
Okay, and then it says example where the gain is passive. Pete has a $500,000 passive loss carry forward over from Xco. Pete also has an interest in YCO. YCO is a passive investment. Pete sells YCO for a $600,000 gain. And then he has a passive loss of 500,000.
Well, I think I must have been drinking when I wrote this. Because the gain from YCO should be 600, right? Not 500. I should have 100 of income. Did you catch me on that, Chris, before I said it?
No, not before you said it.
Seriously, I could have been drinking at this point, watching football. And that's a little bit different. I made it activity 1 and activity 2 over here on the balance sheet. But it could easily have been that I also have Y that sold for 6,400, 400 a basis, 6,000 of income from the sale of Y. And the gain from the sale of Y, which was a passive activity, is passive gain for purposes of netting. Okay, I'm so bored with this, but I gotta continue with it. Max, what's this say?
3B, are the various categories of portfolio income taxed in the same manner? No, you have to determine the character of the income. The character of income loss will determine how that item of income is taxed.
I have a question. Does everybody understand character and what that means? Max is shaking his head yes. Okay. Max, call on somebody and make them explain to me what character means, because I would love to skip this.
Chris, can you explain?
It's a character of income. It could be a capital asset and generates capital gain or loss, or it could be an ordinary income item. And they get taxed at different rates on each tax.
Okay. Allie, you know I'm coming to you. How do you feel about that description?
Good, so it's just like, okay, because going back to what I read at the beginning, you said
I
category.
have no idea.
It's like category is not the same thing as character, right?
Maybe that is what I was talking about.
Yeah.
Okay. But do you feel good or bad about Chris's explanation?
Good.
Good? CV?
I guess.
Okay, I think I can skip this. I'm bored already. Is it okay that I'm bored with this? Do I want to talk about this? I do want to talk about this. Because this occurs quite a bit. Allie, what's 3D say?
What if a taxpayer borrows money to purchase a portfolio asset that produces portfolio income? Can they deduct the interest? My favorite answer, it depends. The deduction is called investment interest. This is not really correct. What I should have said is that it is deductible, but facts and circumstances dictate the timing of the deduction.
Okay. So, investment interest, if you buy, let me ask a stupid question. Does anybody, I'm not going to ask. I'm sure somebody in this room might have a car loan. And somebody's paying interest on that car loan. And that car is a personal asset. That interest is non-deductible. If you buy a house and you have interest, you can deduct that up. Did they revise that down from 750 or to
It's
750?
750.
They took it to $1 million to 750.
It's 750.
Okay, up to $750 million, $750,000 loan can be deductible. Okay, and then there's this concept of investment interest. If I take money and go buy Berkshire stock or GE stock or whatever business asset, I can take that and write it against certain types of income. Okay, so what this is saying is, can I deduct it? And my favorite answer is, it depends, because you have to Sam,
Diagnose.
diagnose whether you have the proper type of income to take that expense against. It has to be the proper type of income to deduct that amount. So can I deduct that, Sam, against W-2 income?
Like what against it?
Investment interest. So if I buy a portfolio asset, I buy Berkshire stock, and it generates $1,000 of investment interest, can I take that against my W-2?
I don't know. My instinct is no, but I don't know.
You go with your instinct,
No.
okay? Because it's only certain types of income. And those certain types of income are going to fall into the portfolio income, which is interest, dividends. We'll just stick with those, okay? So, but let's see. Is investment interest deductible continue? Is it deductible against portfolio income that is taxed at ordinary rates? So the trick here is that you have to have an item of income, portfolio income, that's taxed at ordinary rates. So if I get interest off my bank account, going back to the example that we just had of $1,000 interest income, is that investment interest deductible
Against portfolio income.
against interest income, which is taxed as ordinary? Okay, and if I have a non-qualified dividend, is it deductible against a non-qualified dividend? The answer to that is yes. But if I have capital gains that is taxed at not ordinary rates, the answer to that is, well, maybe. Because this happens with Kiewit stockholders all the time, okay? You know, I know a client this year is going to have a $2 million dividend coming off Kiewit. He has lots of investment interest. So the question is, the beginning rule is you don't get to take investment interest against something that has a capital gain tax inflicted upon it. Yeah.
What about the short-term rates?
Short-term gains?
Yeah, sure, because that's the ordinary rate.
I don't know the answer to that. I was afraid somebody was going to ask that question. Do you know if short-term, my instinct,
I don't know that answer.
okay? My instinct is you can max, but I don't know. Okay, I suspect if you work your way through the 4952, which is the investment interest form, it would tell you, but I can't remember off the top of my head. But I'm going to stick with just qualified dividends or capital gains. That my general rule, the rule that we started with, you can't deduct investment interest against that. So there is an election that can be made that says, well, wait a minute. I'm willing to sacrifice the tax rate on certain amount of income in order to get the deductibility. So if I had the $1,000 worth of interest expense that we were talking about, and I had $1,000 worth of capital gain, which would be taxed at 20%, $200, I can say, well, you know, I want that $1,000 deduction, so I'm willing to turn off the capital gains rate that would be inflicted on that 1,000, and I'll take the 37% rate and pay $370 on that. Okay, and now I can offset those two and get a deduction for my investment interest. This happens with Kiewit shareholders all the time. So if somebody's going to be a Kiewit for 20 years and they have 100,000, because let me take a step back. Does it sound like a good idea to exchange a 20% rate for a 37% rate just on the face of it? It does not. But if I'm at Kiewit for a period of 20 years and I have this investment interest building up and I have $1 million worth of investment interest expense, $2 million worth of dividend, but I don't make that election, well, that $1 million of investment interest doesn't get deducted, it gets carried forward. And I'm taxed on the $2 million worth of dividend. So is it better to take the interest, say, fine, tax it all, tax the piece that was deducted as ordinary, and allow me to have the deduction and reduce my income over the next 20 years? That's a much better choice.